forecast 2 days into the future. A reading of 1 is bullish, a reading of 0 is bearish. So it's either one or the other. So in this particular case, we had the turn, we had the Neuro Index at 1, we had the predicted difference turning up, giving a crossover signal, and we had the start of the predicted moving average giving a starting to turn up in this vicinity right here. So what we're going to do, we're going to just kind of run through a little bit of a trade here, and to show kind of what happens. As I say, we can't go through all of them, but we'll just talk about a trade or two here and how we would get set up, how we would trade the breakout. On this particular day that we are looking at here, where we start to make that turn on December the 15th, which is a candle right here, we had a predicted high of 70.44. So that means that, based on our guideline of using just that $1 higher than the predicted high, we're going to be buying at 71.44. I'm kind of eyeballing across the whole chart here, so I'm not sure if that's exactly 71.44, but it kind of makes the point as to what it is. Now, with this entry point, 71.44, remember we said that we do not want to risk more than $1,500 on this particular position. So we would like to have a stop at a natural point, but when you look at some of the potential places for a stop, if you look down below this low here, for example, that might be a little bit too far down, too much of a spread in there, because if it does go down to there, we could be out more than what we would like to allot for this trade, and that's at $1,500. So if we go the $1,500 below the 71.44, that means we're going to be putting our initial stop at around 69.74 or 94 rather, or roughly around, let's say around $70 even, which puts it somewhere right in this vicinity here. Now that's the initial stop to get set up. If the market, the next candle rather, does drop, you could be out of the market almost before you start. But it's very important to keep the risk at a minimum, and if that's what your clue is to get out, best to get out, because there's no use taking a chance on something if you don't have a bigger account. Now you can imagine if you have a $10,000 account, pretty hard to trade a full-size crude oil contract, because that requires half of your margin, half of your account for margin in one trade. You don't have that kind of risk. If you said, well, I'm going to be 3% on there, that's $300. In crude oil, that's not nearly enough to be able to ride out what's going to happen in the market and take advantage of that breakout situation. But once you're in the market, once you have a position established and you have an initial stop in place, then what you can do is you keep moving that trailing stop below the predicted next day low, so that when it does turn, and it will, the markets are always going up or down or whatever. It's going to trade typically in a trend, then it's going to go sideways a little bit, or it's going to have a little bit of not inactivity, but different types of activity in the sideways, choppier movement, and then trend again, kind of an alternating type scenario. In this particular case, when this market did move up, we had a situation where we get to this candle right here, and we have this was on January 11th, we had a predicted low at that point of 81.79. So we are going to sell, our get out point is going to be 80.79. Again, I'm going to be drawing this kind of spot here where I'm not exactly sure if that's precisely where it falls, but at 80.79 you're going to be out of this market, and potentially, depending upon how you like to do things, could be a stop and a reverse type situation. Generally, I like to make one decision at a time, so I might not be in a situation where I'm going to do both stop and then reverse. I make two decisions. I may get out, and then if it looks like the market is going on lower, then I would use that as a point in which I would enter to go on lower. A lot of other points we could talk about on this chart. We can go into, for example, we have a similar situation that kind of shaped up here in early February. First of all, we had this little, jump up and then, flip back down. There are times that it's going to happen. You're going to lose some money sometimes, but if you keep it down to $1,500, you can come back to trade some other day, because you're going to try to catch the breakout to get the better moves, the richer moves that are going to, pretty much increase your account, even though you have to take some losses along the way. We get into about in this vicinity right in here, we have another situation where we have the predicted moving average crossing up above the actual moving average. We have the predicted high on February 16th at 75.27, so we're buying at 76.27, and if we're buying at 76.27, we're in at about, again, we're eyeballing it a little bit right here. It does take sometimes a few days to be able to do that, but we'll say that we're getting in at, well, let's see, let's see, I misspoke here, I think. Well, no, this is right. Somewhere in this vicinity right in here, anyway, is a point at which we would have gotten into the market. Now, the problem that you have, of course, with our $1,500 guideline is that in this particular case, when we had, cut our risk there, this candle right here would have, the low would have extended below and it would have stopped us out. But we could have come, right back with, on this particular candle, use that as our predicted high as our guideline as to where to get in, and that is where we would then get in the market at 76.27 and keep our stop at 74.77, again using that $1.50 per barrel or the $1,500 risk guideline, and we would then keep our stops, trailing stops below this area right here, never risking again more than $1,500 on this particular trade, because that's all we want. We don't want to lose any more than that on a trade. Now I'm going to zoom in a little bit further here and try to make it a little bit more precise. We're going to cut our vantage point time frame down. As I said, we've been looking at a 6-month chart. You know what that 6-month chart looks like now, but we're going to cut this time back down to a 3-month chart and take a look at how we would have traded more recently using a breakout type of strategy. When we are looking at the trade out or the breakout strategy, we can go short, we can go long, really doesn't matter. The only thing that matters really when you're talking about a strategy to get in is, number one, kind of what is the precise point at which you're going to get in. Number two, what is the extent of the risk that you're willing to take, and that will determine how you're going to place your stops. It will determine the number of contracts you're going to be trading. I would prefer, if it were me, to trade too many contracts if I'm talking about crude oil, because it would give me some flexibility to get out of half of my position if I see a profit. I know there's some discussion about letting profits run and so forth among technical analysts. However, I am one of those who thinks that in some cases, it's kind of maybe a psychological thing or whatever, but it's probably better to take some profit along the way, to cover up those little $1,500 losses, and you don't want to, get rid of the whole position. But that's why if you have a possibility of having a multiple contract position, gives you the chance then to get out with part of it with some profits in your pocket and decrease the risk on your remaining position. Okay, now let's go here and we talked about how we got into the market on the high side and how we were able to get in here for a long trade. But let's take a look now at how it happens if we are looking at a situation where we want to get in on the short side. There are some